And many thanks for participating in the webinar today. We've got a very interesting speaker, a very experienced, who I'll introduce very shortly. Just for the purposes of today, my name is Eamon Keaveney. I'm a sessional lecturer at James Cook University. I've been here for about 3 years, focused on business. Just in terms of general housekeeping, this particular webinar will be recorded for publicity purposes. And I think it has been mentioned in the chat box, you'll have an opportunity to ask questions at any point in the webinar through the Q&A function. Q&A will be taken at the end of the presentation, and we'll also be hosting a satisfaction poll and a survey at the end of the webinar. Again, if there are any technical issues, please just use the chat button to communicate with our event organizers. So again, welcome and thank you very much for participating today in this very interesting topic. The topic today is technological innovation in Asia and investment opportunities. We're delighted to have with us Mr. Herston Powers, who's a managing partner, co-founder of 1982 Ventures. I'll just give a very quick intro and then I'll pass over to Herston to talk through where he's seeing opportunities in Asia currently and a bit about his firm. Prior to founding 1982 Ventures, he was a principal at the Tribe Group here in Singapore and works on a number of investments such as Alami, which is a leading Indonesian Islamic finance platform, and Gradana, which is a pioneer in PropTech in Indonesia. He also spent a lot of time at the BNY Mellon, giving him nearly a decade of experience in the global financial industry. He spent a lot of time in Asia, particularly in Hong Kong and China, working on unlisted pre-IPO and listed companies. He has an executive MBA from INSEAD and a Master of Economics from Hunter College in New York. Hurston, thank you so much for today. We welcome you to the webinar, and I'll pass over to you to talk through where you're seeing technological innovation and investment opportunities in Asia. Thank you.
Yeah, thank you very much. And thank you to James Cook University in Singapore for allowing me the opportunity to speak to you all about what we're seeing on the ground here in Southeast Asia. A little bit of a disclaimer. This won't be, I guess, your typical corporate innovation presentation. We're going to go pretty deep into what we see on the ground, very early stage, and where we see some of the most amazing investment opportunities. So we'll be talking a lot about early stage venture capital, what we see as the key investment opportunity in Southeast Asia, which is financial services and fintech, and why the time is now. Let me just share my screen here. So, as Eamon mentioned, my name is Herston Powers. I'm a co-founder of 1982 Ventures, and we're a licensed fund manager here in Singapore. We have a pretty specific thesis and mandate. We invest in early stage fintech companies in Southeast Asia, and we've been doing it for nearly half a decade. What we offer in venture capital is basically a financial product for investors to generate strong returns, access to a uncorrelated asset class, which is private equity and venture capital. So you generally can't get access to this in the public markets. And what we offer investors also is the ability to invest directly into these opportunities, which generally are not available to high net worth individuals, family offices, and others. You really have to be doing this. And as a small fund manager, we're also giving direct engagement to the principal decision makers or the general partners. So, what we're demonstrating is that to be successful in venture capital, you need access to the best and high quality deals. And how we've achieved that is by being extremely focused on our sector and our specialty in fintech. So we're quite confident in our ability to get invited to some of the most exclusive fintech rounds in Southeast Asia, but also to identify what are going to be the next great fintechs. We can say that because this is all we do in fintech. If I were to look at robotics, F&B, deep tech. These are areas where I know 1982 Ventures probably doesn't have a competitive edge. So it's very important in venture capital to ensure that you are getting access to the best deals and the best founders. And later in the presentation, I'll go through some of these business models to give you a better sense of what's happening in Southeast Asia and why we think these companies will be the next unicorns in this market. But fintech in general for Southeast Asia represents a once in a lifetime opportunity. Fintech in Southeast Asia is a bit behind compared to markets like Australia, China, India, obviously the US and Europe, and even emerging markets like Latin America. The fintech ecosystem has just not developed as fast, but it's catching up very quickly. The other amazing thing about Southeast Asia is that Southeast Asia has some of the best macro and demographic drivers of all markets. So high GDP growth, rising middle class, and a very young population that is going online and going online in a very meaningful way. The other side of the picture is that financial services just have not kept up with the digital economy. So Southeast Asia has a massive financial inclusion problem. So in our view, fintech is really what's going to be the backbone and the driver of the Southeast Asian economy going forward, as it has the ability to begin bringing more individuals and SMEs and businesses into the financial services ecosystem. And in our view, this is the best opportunity because these future fintech champions are being seeded today in Southeast Asia. When we think of fintech across the world, these are some of the most valuable VC-backed companies in their markets. For example, Stripe in the US is one of the most valuable private companies. Klarna and Checkout.com in Europe, Ant Financial in China, Paytm in India. These are the top of valuations in their markets. In Southeast Asia, we do not really have these companies yet, or a version of these companies. So it's a massive opportunity because we know what the future looks like and in fintech and what's going to happen to these markets. A lot of times when people think about fintech, they start thinking about very esoteric things such as blockchain and cryptocurrency. But in Southeast Asia, the biggest opportunities are solving the most simple problems, allowing people to make payments, giving people access to bank accounts, credit and debit cards, and access to financing and protection and insurance. These are some of the simple problems that founders and startups are starting to solve in a meaningful way. I already went over some of the key drivers, but it's a classic emerging market story. We see rapid urbanization, rising middle income, and a young population that's adopting technology at some of the fastest rates globally. Mobile and internet penetration in some of the markets in Southeast Asia are higher than anywhere in the world. So you've got this really positive story here that's driving e-commerce, ride hailing, and online travel, all of the things that have become unicorns in Southeast Asia. What hasn't kept up, as I mentioned, is the financial services. And that's where fintech is really going to drive the returns and GDP of this region. The investment into fintech by venture capitalists in Southeast Asia is growing, and it's growing at a nice rate. But compared to the rest of the world, we're still way behind as a percentage of VC investment that's going into the fintech sector. When you look at China, nearly 30%, global averages at 15%, Southeast Asia is only at 6%. So there's plenty of opportunities to fill that gap, and that's what 1982 is doing. When we look at the landscape and what the market is doing, the fintech VC ecosystem is getting better. The rounds are getting larger. It's not uncommon to see fintech startups raise over $100 million in rounds. This was unheard of a few years ago, but it's becoming more and more commonplace as the VC, fintech, and venture capital ecosystem in Southeast Asia matures. Additionally, fintech is a sector that is highly acquisitive. There's a lot of M&A and consolidation that happens in the fintech sector. This is very positive for investors, especially early stage investors. So we're starting to see more of the unicorns in the region starting to acquire some of the early stage fintechs. And there's about 10 billion USD of unrealized exits in Southeast Asia itself, with about 100 projected exits. So digging down a little bit more into venture capital itself, this is something that we have to continually educate the market in Southeast Asia, especially to investors thinking about starting to invest into startups. Fact is that the data and the research shows that small seed funds outperform larger later stage VC funds. So even from a risk return weighted basis, you see that the seed stage funds are generally the best performing funds of a fund manager, and they continually rank as the top funds on a performance basis across asset classes. So in the US, this is very well understood, and some of the notable US funds, their flagship strategy will be their seed fund. And this is where we like to play. In venture capital, another misconception that we see in Southeast Asia is you see investors wanting to wait till companies get to later stages, thinking that decreases the risk. We see that as not the case, that actually the way to capture value and returns is by going earlier, because venture capital is defined by what's called the power law. And it means that your portfolio success is really determined by a handful of companies that grow exponentially in valuation, that explain why your fund is successful, that provide returns above and beyond any of the losers that you have in your portfolio. And you know what you can lose when you make an investment. It can go to zero. That's defined. But the upside at seed stage is exponential. It's unlimited. And that's where this asymmetric relationship with investing really exists. And it really, truly exists at the very early stage. And in Southeast Asia, that is defined as seed stage. This is actually the journey of a startup, and this will demonstrate why we get those returns. This is based on real valuations in Southeast Asia. And you can see these are about the average of what you see at each stage, whether it's seed stage, Series A, Series B, or Series C in Southeast Asia. What you're seeing is that in each successive round, you see where the multiples are occurring for each type of investor. So for a seed fund like ourselves, it's targeting about a 3 million USD post-money valuation when we invest. By Series A, we're at about 5.5x on average valuation for this region. By Series B and Series C, you're already looking at about 18 to 60x on one investment. So that's the type of multiples that early stage investors are achieving in successful startups. And to be frank, all I need is one of my companies to reach Series C to return my entire fund. And I'm investing in 30 companies. So the idea is to get enough at bats, as we say, to get enough portfolio diversification at the seed stage that I have one absolute winner or a few in my portfolio. The landscape in Southeast Asia has changed a lot. Venture capital as an industry is relatively new, and really Singapore has been the hub for Southeast Asia. So only within the last 5 to 10 years have we seen the start of new venture capital funds in the region. Those funds were very successful, investing in the champions that we know today, such as the Razors, the Grabs, the Gojeks, the Tokopedias, and the like. And their AUM has increased as they've grown. And what that has left is a seed space in Southeast Asia. So for young entrepreneurs, the seed round is actually one of the hardest rounds to raise, because you have fewer and fewer VC funds that are willing to write that first VC check for a startup. Now they're more focused on Series A and Series B, and that's a function of their fund size. There's an old adage that your fund size is your fund strategy. So if you're running a 150 million, 200 million fund, you can't really write a $250,000 or $500,000 check to a startup. You need to deploy 2 to 3 to 5 million per investment, and that's where there's now a huge gap in the seed stage. What's good for seed investors like 1982 is that that cohort of venture capitalists and investors now are downstream investors. So we write that first check to a great fintech founder. We point them in the right direction, and then we help those companies then get to Series A with some regional name brand funds and global funds that are looking for the next fintech startup for their portfolio. So what we're doing, and this will give you a little bit an idea of our portfolio construction. So as mentioned, we want to be the first VC invested in a great startup, especially in the fintech space. This is going to allow us to deliver outsized returns to our investors. So our portfolio will be about 30 companies. We've done the research to find that that's generally an optimal number of companies for a seed strategy. This allows us to get enough portfolio diversification, but then also allows us to get enough equity ownership in each company that we invest in. As mentioned, we're focused on the seed stage. So what we define as seed is not necessarily a PowerPoint presentation and an idea. It's a founding team that's full-time, that's built a product, and that hopefully has launched that product either in a pilot, POC, but the product is at least in the hands of a few customers. That's how we define seed stage. Our average check size is about 250,000 US per investment, and then we allow our investors to co-invest alongside us. We can go as low as 100,000. We're generally holding our companies for anywhere between 4 to 8 years before we begin to exit and start taking some money off the table. And for seed stage investors, that is happening around Series B, as early as Series B, but definitely by Series C, there's exit opportunities for seed investors. And then our target valuation, and we try to stay fairly disciplined around this because this is the only way that the model will work, is making sure that we're getting in at about 3 million USD post-money valuation with a target ownership of about 10 to 15%. Now, when it comes to the innovation in fintech business models and what we're seeing in Southeast Asia, let me just kind of go through some of the recent investments that we made and give you an idea of what they're doing and how they're transforming financial services in Southeast Asia. So Brick is an Indonesian fintech that provides a financial API that allows technology companies to then offer and embed financial services within their core offering. This allows those customers, whether it's a fintech, an e-commerce player, or even a telco, to connect directly to banks, insurance companies, and other financial institutions to then offer financial services through their platform. In the US, there's a company called Plaid that's done this. It's done incredibly well. Visa attempted to acquire it for 5.7 billion US dollars. And the US is obviously a very sophisticated, developed financial markets. So imagine that product, that necessity of having a pipe, a financial API to connect technology companies to financial institutions is needed that much in the US. Imagine the need in Southeast Asia where these pipes don't exist generally. So we're very proud of this investment, and we think it's the right time for this technology to be offered to the ecosystem. It's done incredibly well. We invested in October, and we're already about over 5.5x on that investment. Fundin is a Vietnamese startup that's doing buy now, pay later. And if you've been following the news, especially if you're sitting in Singapore or Australia, you would see that buy now, pay later is probably one of the hottest segments in tech, not just fintech. Vietnam is a market that everyone is clamoring to get into. I think COVID has hampered that a little bit because of travel, but we've got a Vietnamese buy now, pay later, and there's some nuances around the model that make buy now, pay later, what I would say, a special offering, in the sense that there are many credit fintechs that claim to be buy now, pay later, but not really providing the pure BNPL business model that we see as very consumer friendly, especially in markets where credit cards are just generally not available. So we find this a very appealing way to offer consumer-friendly installment payments for large populations, which thus increase the amount of revenue that merchants can generate, whether that's online or offline. So very incredible model. There's some real nuance to it. Homebase is a prop tech that focuses on home financing in Vietnam. So what Homebase does is that it allows consumers that have traditionally not been served by traditional financial institutions to actually buy a home. And the way that they are able to do that is by taking a down payment from that consumer and then acting like a landlord. So it's a rent to own model for property. And the fintech Homebase actually acquires the property, working with their customer, and thus becoming their landlord. And it's a really interesting way for millennials to get into the ecosystem. It also allows entrepreneurs that may not show a lot of income on paper to get access to their first home. And the consumer behavior in Vietnam is changing a lot, where where young people don't necessarily want to live with their immediate family anymore, and they want to live on their own. So this company is doing incredibly well. It was one of the first companies accepted to Y Combinator from Vietnam. Infina, if you've heard of a company called Robinhood or Public in the US, that's what Infina is trying to build. Vietnam is a great market with regards to retail investment compared to the rest of Southeast Asia, excluding Malaysia and Singapore. The retail penetration is at 3%. So only 3% of the population is actually actively investing in the stock market. So you can imagine how much growth is going to happen. But compared to places like Indonesia, where it's just about 1%, we think there's a lot of opportunity in Vietnam with a retail investment platform that's offering products to individuals that are not getting access to the ability to save and make investments. We opportunistically invest into places like Bangladesh and Pakistan out of our fund. Those markets are growing incredibly fast. They're very large populations, but they're a little bit further behind than markets, say, like Indonesia. So you still have opportunities in markets like Pakistan and Bangladesh to get into what we would call kind of Internet 1.0. That's like online travel aggregators. And that's what GoZion does. There's 165 million people in Bangladesh. They're coming online, and they're coming online fast. And there's no market that does not have consumers that don't purchase their travel online. It's just how markets develop, whether it's China with Ctrip, India with Make My Trip, and Indonesia with Traveloka, Expedia in the West, and Booking.com. This is going to happen in South Asia, and we believe we've found the leading one. NextPay is a Filipino startup. They offer an all-in-one solution for banking and payments for SMEs. And SME banking is one of the what we would say one of the biggest pain points for many business owners in the region, not only the Philippines, but Indonesia, and I would say even in Singapore, which is a developed market. SMEs are still not being served in a way that delights them, one, but also just not getting access to financial services. So NextPay, another company that was accepted to Y Combinator like Infina and Homebase, provides digital banking solutions for SMEs and micro SMEs. Wagely is a very interesting model that they actually kicked off. They're the first company in Southeast Asia to provide earned waged access. So this is a model that's been popularized in the US, throughout Europe, and other emerging markets. But what they do is they partner with employers, with corporates. So whether it's a multinational, a state-owned enterprise in Indonesia, or an SME, they partner with that corporate to then provide a wellness benefit for their employees. And that benefit is it allows employees to access their wages as they earn them before the end of a pay cycle. There's no interest rate, so it's not a loan. And it really helps alleviate some of the financial stress of many people, not just in Indonesia, but this is around the world, that are living paycheck to paycheck. So at the end of the month, whatever they advanced gets netted out. They pay a transaction fee that is flat, no matter how much they withdraw at that time. And what Wagely does is then also provide what I would say financial literacy to all of the users on their platform. So they've scaled incredibly quickly, partnering with corporates to provide this benefit. And it really helps eliminate the need for people to go to payday lenders, to loan sharks, or even ask their employer for a loan. So a very, very interesting model, especially for these markets. So we get questions a lot about our backgrounds and how we got into venture capital. Yeah, I'm not ashamed to say it. But, I used to be in banking. I learned a lot there, but I wouldn't say banking is the ideal path to getting into venture capital. I don't think you necessarily need a banking background or even a management consulting background to get in venture capital. My partner and I, we fell into it and we love it, and we've been investing in fintech together for the last 5 years. And for anyone that's looking to do this, you don't necessarily need to follow the mold, and I think we can talk about that more in the Q&A. And that's where I'll stop it right now. I mean, we think that the innovation in the provision of financial services in Southeast Asia is the key investment opportunity globally. This market will continue to grow and grow, and fintech is now where the smart money is coming. You're starting to see more US technology companies, more US VC funds coming into Southeast Asia. The Chinese technology companies have already been here for the last few years. So Southeast Asia is really getting a light shown on it. With Grab and the Gojek and Tokopedia merger, we're going to start seeing more institutional investors from across the world start looking at Southeast Asia, and we believe fintech is where they'll invest. Thank you.
Super. Herston, thanks so much. That was a fantastic presentation, very informative. We have questions coming through, as you will not be surprised at all. I'll kick off with the first one. We'll answer live. Do you think it is possible to replicate the GameStop phenomenon, particularly in Asia?
I love that question. That's such a great question. Not today. In my view, there's not enough retail participation in the market yet. Maybe in some markets there is, but where we look at in Southeast Asia, there wouldn't be enough to create that type of momentum or phenomenon that would create those outcomes that we saw with GameStop. I think in the future there definitely could be, and that's what we're betting on. So I think first things first is that we need to get more of the population in Southeast Asia actually saving and investing for their future. And the only way to do that is to offer products and financial products that are fit for purpose for an individual in Indonesia or Vietnam and other markets. So short answer, not yet.
Fantastic. Okay, another question. What do you speculate to be the next big innovation for fintech?
Yeah, I mean, in Southeast Asia, it's a white space. It's a whiteboard, so to speak. So everything is available to do. When we think about innovation, we're thinking about the ability for more people to get into the financial services system. And we think that the infrastructure around the provision of financial services is where we're going to see a lot of innovation. So let's call stage one of fintech development is the bread and butter, the ability to transact digitally, the ability to send money to relatives and to do remittances. That's kind of what people have been focused on for the last few years. Now it's about, okay, then how do we keep moving down this value chain? So you're going to start seeing more digital lending, not just P2Ps, but actual digital neobanks in Southeast Asia. So when I think about how Singapore versus the Philippines versus Indonesia has approached neobanks or digital banks. They all have different approaches, and there's all a different opportunity. I think we're going to start seeing a lot more from markets like Indonesia and Vietnam specifically on the digital banking side. So the space that I'm probably not the most uh, apt to talk about is the DeFi space. We're still trying to put our thesis together around how that relates to the investments that we make and what we see are the real on the ground problems in Southeast Asia. But obviously there's a lot of momentum in that market. It's highly volatile, and people have become have done really well in that market. So we need to understand a little bit more about the decentralization and how that applies to the core problems and the core opportunities in Southeast Asia.
Super. And thank you, Herston. Another question. Do you think the fintech firms in Southeast Asia will encounter a similar situation as Ant Financial had in China? And what are the major risks you think for fintech firms in Southeast Asia?
It's a great question. I would say no, and not categorically no, but there isn't a firm in Southeast Asia that has as much power as Alibaba or Tencent, compared to how much power they have in China. The penetration rates for even the most successful tech companies and fintech companies in Southeast Asia is very, very low. Digital payments is not ubiquitous here as it is in China. They're the largest asset managers and banks in Southeast Asia are still traditional, where the largest fund managers in by AUM in China were those technology giants. So I don't think that there's enough power here with the technology companies. I do think that, and I think this is more a problem for social media companies, so it may not necessarily affect the homegrown players. So the Facebooks, even Google, the things that potentially are disruptive to, I'll just say it, democracies or to governments. I would see more of a clampdown on those areas compared to fintech. Fintech itself is generally welcomed by the regulators in Southeast Asia, because every government and every regulator sees that there's this massive amount of people and businesses that are underserved and underbanked or completely unbanked. And if fintech can provide financial services to that population in a responsible and sustainable way, we believe that regulatory and government affairs will continue to support it as long as every fintech is being responsible.
Fantastic. Another interesting question. It's quite topical as well. What do you think of Bitcoin now? And I guess the durability of cryptocurrencies. Are they really sort of here to stay? Are they going to be, essentially authentic going forward as a means of store of value and payments? What's your view?
Yeah, it's hard to make predictions. Our fund is not investing in tokens or Bitcoins. So that's not part of our strategy. Personally, I think it's fun. I think it's fascinating to watch. You have to expect to potentially lose money and see some very high volatility. But I believe that there is a transformation happening. I believe that the market is institutionalizing quicker than expected. So you're starting to see more and more institutions, traditional financial institutions, either investing into cryptocurrencies or providing services for their clients to invest in cryptocurrencies, and then building the institutional infrastructure necessary to allow a Fidelity or a GIC or whoever to actually participate in those markets. So that's one area that we like a lot. And we want to see the infrastructure to make those markets institutional. It's happening. That's where we would invest. So short answer, I guess, yes, here to stay. How it gets there, I don't know.
Okay, fantastic. Maybe time for maybe a few more questions. They're coming thick and fast. You're very popular, which is great. We've got a budding startup individual interested in forming their own startup company. They say that you mentioned that seed funding will be forthcoming for businesses, not just on a PowerPoint and business plan, but something that's actually in operation. So would that be, if you could elaborate further, would that be proof of concept? You mentioned that very important to have a product in customers' hands. What other things are important, to attract that seed funding?
Sure. That's my criteria. I mean, every investor may have different criteria about what they need to see. Ours is around there. If you're just starting, there's many avenues to getting enough funding to get you to product. It takes a lot of work. So you're going to have to tap into, and apologize, I don't know exactly where you are in your journey, but you'll either fund it yourself, do friends and family, and try to find the right team of people that you want to work with for the long run that complement each other, that are the ability to get to hit your milestones, and start putting something together. And I think as you develop your network and establish credibility in the space that you want to attack, you should be able to, you would try to raise enough money that allows you to build something. And it doesn't need to be the most sophisticated product. It needs to be enough to get you in the door, to allow you to start having those pilot conversations and to really test if what you think is right. And one thing that I would recommend for anyone thinking about this is, don't sit in your room or sit in a PowerPoint too long. Don't research. Obviously, conduct the research, but don't stay there. You need to get out and speak to people that potentially will be your customers, or that can give you access to potential customers, so that you can actually identify what are the real pain points, what do they need, and most importantly, will they pay for it? And those are the types of questions that you can answer before building a product. And many times you can build that product alongside the potential clients if it's a real pain point. But fast forward to after you've kind of either bootstrapped or been able to get that angel money, you've been able to show some traction. I would say it's never too early to speak to a VC, an early stage VC fund manager. What we may not invest when we first meet you, but if we like you and we think what you're doing is interesting, and even if we think what you're doing might be a little bit off, if we like you as a founder, if we say we really want to track this person because there's some talent there, so we want to stay close to this person, and maybe in 6 months you come back with a totally different idea. Say, you know what I told you didn't work. This is what I learned. Now it's working. That's great credibility. And now I've been following and watching your story. So what I would do is, identify the investors that potentially can invest in your space. So for example, if you're doing something in mobility, you'd want to focus on investors that have made investments there or have a strategy that clearly states they're looking for that. If you're doing something fintech, then you would come to someone like 1982, say, this is what we're doing. We want to get on your radar, want to get your feedback. We're going to be back in about 6 to 12 months raising our seed round. We'll keep you updated. And this is the thing that nobody does well, including myself, is actually have the discipline to write that monthly or quarterly or whatever period update to all the investors that you spoke to, and say, this month we've achieved this. And I might not respond to that message, but I'll watch it and I'll say, you know what? First, I like the discipline here, and I get to see your journey, so that when you come back to me 6 to 12 months later, I'm already caught up. I know what you've done, and all you need to do is make sure that I write that check. Sorry, did I answer the question?
That's a fantastic answer. Thanks. Another question we'll probably just do, I guess, given time, probably your time for a couple more questions or so. One interesting question in terms of Southeast Asia, beyond sort of Jakarta and Ho Chi Minh City, what are the next sort of hot houses, and how is Singapore positioned in the whole ecosystem in Southeast Asia?
Brilliant question. Brilliant question. So yeah, you're right. Everybody talks about Jakarta, Ho Chi Minh, Manila as the places where you have to be, but those tier two cities are growing really fast as well. And you need to have a view about, can your portfolio companies scale into those markets effectively, or have they been doing it from the start? So we generally haven't taken a strong view on whether we're going to Surabaya next or Bandung as the next in hot investment perspective, because you need to more than likely be nationwide or market wide. But we do think that there's going to be more and more talent coming out of these different markets. So we want to have a good pulse on that. So I guess the short answer is that the quote unquote tier two cities are still massive compared to many other markets. We're going to see them continue to grow as these countries grow. And what we need to do is plant the seeds, not just 1982, but I would say all stakeholders. So government, universities, and have the ecosystem that can support more startup hubs, not just in the capital cities or the major cities. And that's not something that we can do by ourselves, or that one founder can do by themselves. It really takes community to do that, and hopefully there's some market demand for that as well.
Fantastic. Well, I guess we'll probably just stick to two more questions, if that's okay, Herston. One question, obviously, during COVID, we saw, there was like a sort of almost like a two-tier system where you had the fundamental stocks lagging behind massively, understandably, and then the tech stocks, going through the roof. There've been some fears in some quarters that we may be in a dot-com, bubble, 2.0. I mean, what are your thoughts about this? And what would you recommend to sort of guard against that if that was to happen, particularly in the area of fintech? Or is it something that you think is overblown, the fears?
Yeah, well, you're laying me up here, because if you're in the market, you've done incredibly well over the last 12 to 18 months, if not longer. So what many family offices and allocators are doing is starting to rebalance their portfolio. So taking some of the winnings off the table in the public markets, and then rebalancing to alternatives such as real estate, venture capital, obviously seed stage, and private equity. So it really depends on what your portfolio looks like. Whether we're about to see a crash, I never say, just because everybody's been saying that for the last 10 years, that the market is about to drop. There'll be corrections for sure. But if you just invest in stocks that are credible and you believe in, and hold it and not trade, generally you'll do well over the long run. That's clear, right? So I don't have any trading advice for anybody. So as an equity investor, I'm in the private markets. It's been a bit wild to see the public markets being overvalued than private companies, which is a recent phenomenon. So the valuations are higher in the public markets. But whether we're about to see a crash, I'm not sure. I do know that COVID basically accelerated a lot of the digitization of financial services. So our sector performed really well outside of a few verticals. So whether technology is there's going to be a slowing or a major correction, I don't see it. And what we do now when we look at companies, for lack of a better term, we have a screen saying, is this pandemic proof? Because who knows what might happen? We never guessed it, what would happen 12 months ago. So as long as you're okay with the risk and you're identifying, you should be okay. But I won't call it whether we're about to see a major correction.
Fair point. Excellent. The final question, just to put to you, The answers have been great. Questions have been fantastic. One thing that has been noticed that on your sort of list of multiples on invested capital, in terms of your original investment, you tend to cash out around round C. Is there any reason for that, and why you wouldn't go further to the IPO stage, given potentially that the risk is lower once you get post round C? What's the thought process there?
Yeah. So we look at it on a case-by-case basis. So as we get the opportunities to exit, we have to make a decision whether we want to do that. And we really have to look at the trajectory of the company, and also the need to return cash back to our LPs and investors. So generally by Series B, Series C, we have those opportunities. Will we take them always? Maybe not. We'll probably take partial exits at that time. And if necessary, especially for later stage investors, they need more equity than what founders are generally willing to give up at Series B and Series C. Generally, it helps the founders as well. And we've kind of run our course, and we're able to return cash back to our investors. That's not to say that we wouldn't keep some money on the table for an IPO. The thing that I would say is helpful for us is that Southeast Asia historically has not been a great IPO market for technology companies. It's just starting to come online. So the ability to have an IPO within a reasonable time period, it's starting to become much more clear. And if the grab SPAC goes well, if the listings that are proposed in Indonesia happen, we believe it's such a positive development for the ecosystem that we'll continue to see more and more, which may change our exit strategy. But our LPs are okay with 60x, when we're
very good. Yeah,
we're okay with it as well. I would also say that in recent years, many Series B companies, not many, but even at Series B and Series C, companies are going to zero. There have been some examples of that in Southeast Asia. So just because a company gets to that stage doesn't mean you're out of the woods on the risk perspective, and it hurts a lot more for those later stage investors.
Yeah, absolutely. Well, listen, Herston, it's been an absolute pleasure. Thank you so much for your time today. The presentation was wonderful, giving an insight into your process and your investments, and also the questions that were answered perfectly. We really appreciate your time again. From everybody here at James Cook University, we'll send you a link in terms of the presentation so you can share that with your network. So have a great weekend. Thank you so much. We'll be in touch. And to everybody who took part, thank you as well. Have a great weekend, and we'll be in touch again soon. Thank you, guys. All the best.